In today's video, we are going to introduce you to the world of cryptocurrency, discussing concepts such as altcoins, stablecoins, memecoins, blockchain, initial coin offerings, volatility, and the major booms and busts in the cryptocurrency market. A cryptocurrency is a digital currency designed to work through a computer network that is not reliant on any central authority, such as government or bank, to uphold or maintain it. Individual coin ownership records are stored in a digital ledger, or blockchain, which is a computerized database that uses a consensus mechanism to secure transaction records, control the creation of additional coins, and verify the transfer of coin ownership. The two most common consensus mechanisms are proof of work and proof of stake. Despite the name, which has come to describe many of the fungible blockchain tokens that have been created, cryptocurrencies are not considered to be currencies in the traditional sense, and varying legal treatments have been applied to them in various jurisdictions, including classification as commodities, securities, and currencies. Cryptocurrencies are generally viewed as a distinct asset class in practice. The first cryptocurrency was Bitcoin, which was first released as open source software in 2009. As of June 2023, there were more than 25,000 other cryptocurrencies in the marketplace, of which more than 40 had a market capitalization exceeding $1 billion. As of April 2025, the cryptocurrency market capitalization was already estimated at $2.76 trillion. After the early innovation of Bitcoin in 2008 and the early network effect gained by Bitcoin, tokens, cryptocurrencies, and other digital assets that were not Bitcoin became collectively known during the 2010s as alternative cryptocurrencies, or altcoins. Altcoins often have underlying differences when compared to Bitcoin. For example, Litecoin aims to process a block every 2.5 minutes, rather than Bitcoin's 10 minutes, which allows Litecoin to confirm transactions faster than Bitcoin. Another example is Ethereum, which has smart contract functionality that allows decentralized applications to be run on its blockchain. Ethereum was the most used blockchain in 2020, according to Bloomberg News, and in 2016 it had the largest following of any altcoin, according to the New York Times. Stablecoins are cryptocurrencies designed to maintain a stable level of purchasing power. Notably, these designs are not foolproof, as a number of stablecoins have crashed or lost their peg. For example, on the 11th of May of 2022, Terra's stablecoin UST fell from $1 to 26 cents. The subsequent failure of Terraform Labs resulted in the loss of nearly $40 billion invested in the Terra and Luna coins. On the other hand, memecoins are a category of cryptocurrency that originated from internet memes or jokes. The most notable example is Dogecoin, a meme coin featuring the Shiba Inu dog from the Doge meme. Meme coins are known for extreme volatility. For example, the record high value of Dogecoin was 73 cents, but that has plunged to 13 cents by mid-2024. The underlying technical system upon which cryptocurrencies are based was created by Satoshi Nakamoto. Cryptocurrency is produced by an entire cryptocurrency system collectively, at a rate which is defined when the system is created and that is publicly stated. Within a proof-of-work system such as Bitcoin, the safety, integrity, and balance of ledgers are maintained by a community of mutually distrustful parties referred to as miners. Miners use their computers to help validate and timestamp transactions, adding them to the ledger in accordance with a particular timestamping scheme. Most cryptocurrencies are designed to gradually decrease the production of that currency, placing a cap on the total amount of that currency that will ever be in circulation. In the case of cryptocurrency, companies or governments cannot produce new units and have not so far provided backing for other firms, banks, or corporate entities to also do so. Additionally, compared with the ordinary currencies held by financial institutions or kept as cash on hand, cryptocurrencies can be more difficult for seizure by law enforcement. The validity of each cryptocurrency's coin is provided by a blockchain. Blockchains are secure by design and are an example of a distributed computing system with high Byzantine fault tolerance. A Byzantine fault is any fault presenting different symptoms to different observers, and thus, because blockchain has a high fault tolerance, blockchains are inherently resistant to modification of the data. A blockchain is a continuously growing list of records called blocks, which are linked and secured using cryptography. Each block typically contains a hash pointer as a link to a previous block, a timestamp, and transaction data. A blockchain is an open distributed ledger that can record transactions between two parties efficiently and in a verifiable and permanent way. For use as a distributed ledger, a blockchain is typically managed by a peer-to-peer network collectively adhering to a protocol for validating new blocks. Once recorded, the data in any block cannot be altered retroactively without the alteration of all subsequent blocks, which requires collusion of the network majority. Of note, there are also centralized databases outside of blockchains that store crypto market data. Compared to the blockchain, databases perform fast as there is no verification process. 4 of the most popular cryptocurrency market databases are CoinMarketCap, CoinGecko, Brave New Coin, and Crypto Compare. Next up, we will be discussing nodes. A node is a computer that connects to a cryptocurrency network. The node supports the cryptocurrency network through either relaying transactions, validation, or hosting a copy of the blockchain. In terms of relaying transactions, each network computer node has a copy of the blockchain of the cryptocurrency it supports. When a transaction is made, the node creating the transaction broadcasts details of the transaction using encryption to other nodes throughout the node network so that the transaction and every other transaction is known. Node owners are either volunteers, those hosted by the organization or body responsible for developing the cryptocurrency blockchain network technology, or those who are enticed to host a node to receive rewards from hosting the node network. Cryptocurrencies use various time-stamping schemes to prove the validity of transactions added to the blockchain ledger without the need for a trusted third party. The first time-stamping scheme invented was the proof-of-work scheme. Another method is called the proof-of-stake scheme. Proof-of-stake is a method of securing a cryptocurrency network and achieving distributed consensus through requesting users to show ownership of a certain amount of currency. It is different from proof-of-work systems that run difficult hashing algorithms to validate electronic transactions. The scheme is largely dependent on the coin, and there is currently no standard form of it. Importantly, some cryptocurrencies use a combined proof-of-work and proof-of-stake scheme. On a blockchain, mining is the validation of transactions. For this effort, successful miners obtain new cryptocurrency as a reward. The reward decreases transaction fees by creating a complementary incentive to contribute to the processing power of the network. The rate of generating hashes which validate any transaction has been increased by the use of specialized hardware such as FPGAs and ASICs running complex hashing algorithms like SHA-256 and Script. This arms race for cheaper yet efficient machines has existed since Bitcoin was introduced in 2009. Mining is measured by hash rate, typically in terahash per second. A 2023 IMF working paper found that crypto mining could generate 450 million tons of CO2 emissions by 2027, accounting for 0.7% of global emissions or 1.2% of the world total. With more people entering the world of virtual currency, generating hashes for validations has become more complex over time, forcing miners to invest increasingly large sums of money to improve computing performance. Consequently, the reward for finding a hash has diminished and often does not justify the investment in equipment and cooling facilities to mitigate the heat the equipment produces and the electricity required to run them. As a result, some miners pool resources, sharing their processing power over a network to split the reward equally, according to the amount of work they contribute to the probability of finding a block. A share is awarded to members of the mining pool who present a valid partial proof of work. Popular regions for mining include those with inexpensive electricity, a cold climate, and jurisdictions with clear and conducive regulations. By July 2019, Bitcoin's electricity consumption was estimated to be approximately 7 gigawatts, around 0.2% of the global total, or equivalent to the energy consumed nationally by Switzerland. Importantly, an increase in cryptocurrency mining increased the demand for graphics cards, or GPUs, in 2017. And the computing power of GPUs makes them well suited to generating hashes. Popular favorites of cryptocurrency miners such as NVIDIA's GTX 1060 and GTX 1070 graphics cards, as well as AMD's RX 570 and RX 580 GPUs, doubled or tripled in price, or were out of stock. Miners regularly buy up the entire stock of new GPUs as soon as they are available, and NVIDIA has asked retailers to do what they can when it comes to selling GPUs to gamers instead of miners. Boris Bols, the PR manager for NVIDIA in the German region, said, "Gamers come first for NVIDIA." The next topic is a cryptocurrency wallet, which is a means of storing the public and private keys or addresses or seed which can be used to receive or spend the cryptocurrency. With the private key, it is possible to write in the public ledger, effectively spending the associated cryptocurrency. With the public key, it is possible for others to also send currency to the wallet, and there exist multiple methods of storing keys or seed in a wallet. These methods range from using paper wallets, which are public, private, or seed keys written on paper, to using hardware wallets, which are hardware to store your wallet information. Another couple examples are digital wallets, which is a computer with software hosting your wallet information, to hosting your wallet using an exchange where cryptocurrency is traded, or by storing your wallet information on a digital medium such as plain text. From a privacy perspective, Bitcoin is pseudonymous rather than anonymous. The cryptocurrency in a wallet is not tied to a person but rather to one or more specific keys. Thereby, Bitcoin owners are not immediately identifiable, but all transactions are publicly available in the blockchain. Still, cryptocurrency exchanges are often required by law to collect the personal information of their users. Some cryptocurrencies such as Monero, ZeroCoin, ZeroCash, and CryptoNote implement additional measures to increase privacy, such as by using zero-knowledge proofs. A recent 2020 study presented different attacks on privacy in cryptocurrencies. The attacks demonstrated how the anonymity techniques are not sufficient safeguards, and in order to improve privacy, researchers suggested several different ideas, including new cryptographic schemes and mechanisms for hiding the IP address of the source. Next, let's discuss the economic impact of cryptocurrencies, which include block rewards and transaction fees. Cryptocurrency are used primarily outside banking and governmental institutions and are exchanged over the internet, leading to crypto being defined as a decentralized currency. Proof-of-work cryptocurrencies such as Bitcoin offer block reward incentives for miners. There has been an implicit belief that whether miners are paid by block rewards or transaction fees, this does not affect the security of the blockchain, but a study suggests that this may not be the case under certain circumstances. The rewards paid to miners increase the supply of the cryptocurrency by making sure that verifying transactions is a costly business. The integrity of the network can be preserved as long as benevolent nodes control a majority of the computing power. The verification algorithm requires a lot of processing power and thus electricity in order to make verification costly enough to accurately validate the public blockchain. Not only do miners have to factor in the costs associated with expensive equipment necessary to stand a chance of solving a hash problem, they must further consider the significant amount of electrical power in search of the solution. Generally, the block rewards outweigh electricity and equipment costs, but this may not always be the case. The current value, not the long-term value of the cryptocurrency, supports the reward scheme to incentivize miners to engage in costly mining activities. Shifting gears, in 2018, Bitcoin's design caused a 1.4% welfare loss compared to an efficient cash system, while a cash system with 2% money growth has a minor 0.003% welfare cost. The main source for this inefficiency is the large mining costs, which is estimated to be $360 million per year. This translates into users being willing to accept a cash system with an inflation rate of 230% before better off using Bitcoin as a means of payment. However, the efficiency of the Bitcoin system can be significantly improved by optimizing the rate of coin creation and minimizing transaction fees. Another potential improvement is to eliminate inefficient mining activities by changing the consensus protocol altogether. Transaction fees, sometimes also referred to as miner fees or gas fees for cryptocurrency, depend mainly on the supply of network capacity at the time versus the demand from the currency holder for a faster transaction. The ability for the holder to be allowed to set the fee manually often depends on the wallet software used, and central exchanges for cryptocurrency usually do not allow the customer to set a custom transaction fee for the transaction. Their wallet software, such as Coinbase Wallet, however, might support adjusting the fee. Select cryptocurrency exchanges have offered to let the user choose between different presets of transaction fee values during the currency conversion. For Ethereum, transaction fees differ by computational complexity, bandwidth use, and storage needs, while Bitcoin transaction fees differ by transaction size and whether the transaction uses SegWit. In February 2023, the median transaction fee for Ether corresponded to $2.28, while for Bitcoin it corresponded to 65.9 cents. Importantly, some cryptocurrencies have no transaction fees, the most well-known example being Nano, and instead relying on client-side proof-of-work as the transaction prioritization and anti-spam mechanism. Let's next discuss the process of initial coin offerings, price trends, and the volatility of crypto. An initial coin offering is a controversial means of raising funds for new cryptocurrency ventures. An ICO may be used by startups with the intention of avoiding regulation. However, security regulators in many jurisdictions, including the US and Canada, have indicated that if a coin or token is an investment contract, it is a security and is subject to securities regulations. In an ICO campaign, a percentage of the cryptocurrency, usually in the form of tokens, is sold to early backers of the project in exchange for legal tender or other cryptocurrencies, often Bitcoin or Ethereum. 4 of the 10 biggest initial coin offerings have used Switzerland as a base, where they are frequently registered as non-profit foundations. The Swiss regulatory agency FINMA stated that it would take a balanced approach to ICO projects and would allow legitimate innovators to navigate the regulatory landscape and so launch their projects in a way consistent with national laws protecting investors and the integrity of the financial system. In response to numerous requests by industry representatives, a legislative ICO working group began to issue legal guidelines in 2018, which are intended to remove uncertainty from cryptocurrency offerings and to establish sustainable business practices. The market capitalization of a cryptocurrency is calculated by multiplying the price by the number of coins in circulation. The total cryptocurrency market cap has historically been dominated by Bitcoin, accounting for at least 50% of the market cap value, where altcoins have increased and decreased in market cap value in relation to Bitcoin. Bitcoin's value is largely determined by speculation, among other technological limiting factors known as blockchain rewards coded into the architecture technology of Bitcoin itself. The cryptocurrency market cap follows a trend known as the halving, which is when the block rewards received from Bitcoin are halved due to the technological mandated limited factors instilled into Bitcoin, which in turn limits the supply of Bitcoin. As the date reaches near of a halving, twice thus far historically, the cryptocurrency market cap increases, followed by a downtrend. Cryptocurrency prices are much more volatile than established financial assets such as stocks. For example, over 1 week in May 2022, Bitcoin lost 20% of its value and Ethereum lost 26%, while Solana and Cardano lost 41% and 35% respectively. The falls were attributed to warning about inflation. By comparison, in the same week, the Nasdaq Tech Stock Index fell 7.6% and the FTSE 100 was 3.6% down. In the longer term, of the 10 leading cryptocurrencies identified by the total value of coins in circulation in January 2018, only 4, Bitcoin, Ethereum, Cardano, and Ripple, were still in that position in early 2022. The total value of all cryptocurrencies was $2 trillion by the end of 2021, but halved 9 months later. The Wall Street Journal has commented that the crypto sector has become intertwined with the rest of the capital markets and sensitive to the same forces that drive tech stocks and other risk assets, such as inflation forecasts. In the last section of today's video, we are going to talk about the concept of the cryptocurrency bubble and the boom and bust nature of the cryptocurrency market. A cryptocurrency bubble is a phenomenon where the market increasingly considers the going price of cryptocurrency assets to be inflated against their hypothetical value. The history of cryptocurrency has been marked by several speculative bubbles on a boom-to-bust cycle. The first boom and crash came in February 2011, where the price of Bitcoin rose to about $1.06, then fell to 67 cents that April. In June 2011, Bitcoin's price again rose to $29.58. This price then fell to $2.14 that November. The second boom and crash occurred in November 2013. Bitcoin's price rose to $1,127.45. It then gradually declined, bottoming out at $172 in January 2015. The 2018 cryptocurrency crash, also known as the Bitcoin crash and the Great Crypto Crash, was the sell-off of most cryptocurrencies starting in January 2018. After an unprecedented boom in 2017, the price of Bitcoin fell by about 65% from the 6th of January to the 6th of February 2018. Subsequently, nearly all other cryptocurrencies followed Bitcoin's crash. By September 2018, cryptocurrencies collapsed 80% from their peak in January 2018, making the 2018 cryptocurrency crash worse than the dot-com bubble's 78% collapse. By the 26th of November, Bitcoin also fell by 80% from its peak, having lost almost 1/3 of its value in the previous week. And in November 2018, the total current value for Bitcoin fell below $100 billion for the first time since October 2017, and the price of Bitcoin fell below $4,000, representing an 80% decline from its peak the previous January. Bitcoin reached a low of around $3,100 in December 2018. From March 8th to March 12th in 2020, the price of Bitcoin fell by 30% from $8,900 to $6,206. By October 2020, Bitcoin was trading for approximately $13,200, and in November 2020, Bitcoin again surpassed its previous all-time high of $19,000. In early 2021, Bitcoin's price fluctuated wildly, rising to $34,792 on the 3rd of January 2021, before crashing by 17% the next day and reaching above $40,000 for the first time on the 7th of January. On the 11th of January, the UK Financial Conduct Authority warned investors against lending or investments in crypto assets, that they should be prepared to lose all their money. On the 16th of February, Bitcoin reached 50,000 for the first time, and on the 13th of March, Bitcoin surpassed 61,000 for the first time. Following a smaller correction in February, Bitcoin plunged from its peak above 64,000 on April 14th to below 49,000 on the 23rd of April, representing a 23% mini crash in less than 10 days, dipping below the March bottom trading range and wiping $500 billion from the combined crypto total current value. On the 14th of April, Coinbase, a much-hyped crypto exchange, went public on the Nasdaq. Their shares grew by over 31% on the first day to $328.28, pushing their market cap to $85.8 billion. Other cryptocurrency prices also sharply rose, then followed by losses of value during this period. In May 2021, the value of Dogecoin, originally created as a joke, increased to 20,000% of value in 1 year. It then dropped by 93% shortly after. By the 19th of May, Bitcoin had dropped in value by 30% to $31,000, and Ethereum by 40% and Dogecoin by 45%. Nearly all cryptocurrencies were down by double-digit percentages. Major cryptocurrency exchange Binance went down amid a market-wide price crash, and traders are now seeking justice for their losses. This was partly in response to Elon Musk's announcement that Tesla would suspend payments using the Bitcoin network due to environmental concerns, along with the announcement from the People's Bank of China reiterating that digital currencies cannot be used for payments. Bitcoin and other cryptocurrencies experienced a solid recovery after Elon Musk met with leading Bitcoin mining companies to develop more sustainable and efficient Bitcoin mining. After bottoming out on the 19th of July, by early September, Bitcoin had reached $52,633, while Ethereum grew by over 100% to $3,952. After a short but significant fall, both cryptos peaked on the 7th of November 2021 at $67,566 and $4,812 respectively. The Nasdaq would peak 12 days later on the 19th of November at $16,057. However, as of October 2024, Tesla has not yet resumed payment with Bitcoin, although they do accept payments with Dogecoin on select items. In closing, as we've seen, cryptocurrency is more than just digital money. It's a revolutionary shift in how we store, exchange, and think about value. With innovation comes risk, and the cryptocurrency world is no exception. From blockchain breakthroughs to volatile price swings, this space moves fast. If you found today's breakdown helpful, be sure to like, subscribe, and hit the bell notification button so you don't miss our next dive into the future of finance and technology. Thank you, everyone. Have a great rest of your day.